Hello and welcome to our new investment strategy update. The global economy is shifting gears as market concerns change from overheating risks to fears of slowing growth. We are indeed now moving from the early stages of a strong recovery to more normal growth rates. In other words, economies are slowly converging towards their potential growth. Many regions' recoveries are catching up, particularly the UK and the Eurozone, and we also see momentum rotating from trade and manufacturing to services. In the US, fears of persistently high inflation have decreased and the labor market is improving. This has crucial implications for US monetary policy. The Federal Reserve's maximum employment goal needs some more job market growth over the coming months, but the ongoing economic expansion should let the Fed start tapering asset purchases later this year or early the next. This is a natural step in the normalization of monetary policy with important implications for markets. In China, we expect continued growth this year, secured by flexible fiscal and monetary policy. This is despite the recent weakness induced by Delta outbreak, floods, new regulatory frameworks for a number of industries, as well as credit and investment slowdown. There are still challenges, and of course, the pandemic remains a key risk. As vaccines' efficacy fades, governments are planning to roll out booster shots, and with plenty of production through the rest of this year, supplies should be adequate. Overall, key indicators illustrate the economy's strong cyclical position, despite the Delta variant's challenges, and we expect a continued recovery, albeit at a more normal pace, in the months ahead. Let's now turn to Stéphane to discuss this new phase of the cycle and what it means for our clients' portfolios.
This stationary phase of the economic cycle that Sami just described supports a moderate pro-risk stance in our clients' portfolios. That's why we still prefer equities over high-quality fixed income. We believe that corporate profits should stay robust over the coming months. Indeed, second quarter earnings were extremely strong, with a record proportion of business exceeding expectation on both earnings and sales. For instance, in the US, 85% of listed companies beat analyst expectation by almost 20% on average. This is a key indicator of underlying demand strength and good cost control. We overweight regions and styles that can perform well in this environment, namely European and UK stocks, where growth should be stronger in the near term, as well as cyclical and value equities, which have more catch-up potential. We also took advantage of recent market volatility to increase our positions in Chinese stocks. While regulation risk persists, equity valuation in China are now more supportive, and the central bank's monetary policy should become more accommodative, leading to stronger activity and market sentiment. In fixed income, we reduce our exposure to investment-grade bonds, further because the Fed's asset tapering will lead to a normalization in rates. We see better opportunities in high-yield credit, emerging market bonds in hard currency, and Chinese debt in the renminbi. There is also potential for additional returns in infrastructure and real estate, which should benefit from continued fiscal stimulus and low yields, and crucially, in the transition to a net zero economy as market sensitivity to climate risk intensifies. The market outlook remains constructive through the year-end. So far, policy support has enabled a strong recovery. But there will be more volatility ahead, and so active portfolio management remains crucial. The key risk is the emergence of new COVID variants, especially in the under-vaccinated parts of the world. Investors will also need to watch how the historic levels of monetary and fiscal support are withdrawn as recoveries strengthen. Finally, we will closely monitor the evolution of the most important geopolitical relationship of our time, the strategic competition between the US and China. Thank you very much for watching.